I'm Ryan Iverson, and this is the Investor Breakout Weekly Insight. Let's talk about what happened this week. Private credit is facing its first real stress test, and investors are heading for the exits. Ares Management has capped withdrawals at one of its major private credit funds after redemption requests surged. Investors asked to pull more than 11% of the fund, but Ares is limiting withdrawals to 5%. That is becoming a pattern. Firms like Apollo and BlackRock have made similar moves, sticking to that 5% cap to avoid being forced to sell illiquid assets too quickly. Here's the issue. Private credit funds lend to mid-sized companies, but those loans are not easy to sell on short notice. So when too many investors want out at once, managers have to slow things down. That is exactly what we are seeing now. Billions have been pulled from the sector in recent months, and some analysts are calling this a reset moment for the roughly $2 trillion private credit market. So far, this is not about credit quality. Many of the funds say their underlying loans are still performing. This is about liquidity. Investors want access to their money, and these structures are now being tested in real time. The big question is, what happens next? Does this become a broader unwind across private markets, or is it just a temporary shakeout? Let us know what you think in the comments. Where are Bank of Canada rates headed? Right now, markets and economists are telling two very different stories. In just a matter of weeks, traders have flipped from expecting no moves to pricing in more than 2 rate hikes this year, starting as early as July. What changed? Oil. The spike in energy prices has reignited inflation fears globally, and bond markets are reacting fast. But many economists are pushing back. They argue this move is overdone. Canada's economy is still soft. Growth is weak, and the Bank of Canada has given no clear signal that it is ready to hike. Governor Tiff Macklem has said that the bank is willing to act if needed, but is in no rush. The current view is to look through the oil shock unless it spreads into broader inflation. So this may be less about fundamentals and more about positioning. Bond markets got caught offside, and the sharp repricing reflects that shift, more than a true change in outlook. The reality, if oil stays high, hikes are back on the table. If growth weakens, the bank likely stays on hold. So here's the question. Are markets overreacting to the oil shock, or is the Bank of Canada about to pivot back to rate hikes? I'm Ryan Iverson, and I'll see you next week.